welcome back for Chapter 2. Before we get started, I hope you have the notes page printed out if you have access to a printer and have that with you so that you can follow along and fill in the blank and write down the problems. In Chapter 2, we're going to get started to actually recording business transactions. So it's very important that you're writing these down. We're going to learn how to properly record a journal entry. So that's definitely something that you want to practice with your handwriting on the notes to get these down. Now, before we get into actually doing the journal entries, we're going to start with reviewing some of the accounts that we learned very briefly about in Chapter 1 and their account types and the accounting equation that we talked about back in Chapter 1. So remember, our accounting equation is assets are equal to liabilities plus equity. Now, these are our three account categories or account types. Assets is not a specific account, it is a category of accounts. Liabilities is not a specific account, it is a category of accounts. And equity is a category of accounts. So within each of these categories, we have specific accounts where an account is a detailed record of all the increases and decreases for that specific asset or that specific liability or that specific equity. So some of the common assets that we have, and we talked about a few of these back in Chapter 1, cash. Remember, cash is, if we own it, an asset is anything that we own that's expected to provide a future benefit. Accounts receivable, this is money that we are expecting to receive from a customer. So we've done some work or provided a good or service for a customer, and they have promised to pay us later. We are expecting to receive their payment, therefore that counts as an asset. A note receivable is similar to an account receivable, but typically it's for a larger amount. It is a longer payback period. Typically we expect to collect accounts receivables within, the norm is about 30 days. So a note receivable may be for 6 months or a year or 2 years or 5 years. And usually notes receivables have interest associated with them rather than accounts receivable which do not have interest. We'll talk more about the differences between accounts receivable and notes receivable in Chapter 8, but those are kind of the basic differences. I'm going to go a little bit out of order. So land, if we own the land, that's an asset. Buildings, again, if we own the building, it's an asset. Equipment, furniture, fixtures, as long as we own them, they're an asset. Remember that all assets are recorded at their historical cost. So that land, that building, that equipment, it's recorded at what we paid for it, not what we deem it to be worth now. We also have an account category on there called prepaid expense. So this is when you've paid for something before you've used it. Something like a subscription service. Maybe you prepay your insurance. So I pay my insurance. I write one check for 6 months of insurance, and then I'm expecting to receive insurance coverage for the next 6 months. Since I am expecting to receive that insurance coverage, that's a benefit. I'm expecting to receive that benefit. That counts as an asset. Now, once those 6 months have passed and I'm no longer expecting to receive a benefit anymore, I now no longer have an asset. So in Chapter 3, we're going to learn how to go back in and take these prepaid expenses and then transfer them from being an expense to from being an asset to being an expense. Liabilities, remember, is a fancy word for debt. Almost all liabilities have the word payable in the title. Not exactly all of them, but most of them. So accounts payable, remember, is money that we owe to our suppliers, like when we bought the supplies from Office Depot, but we already have an account set up with them. So we said, hey, put this on my tab, send me a bill, and I'll pay you later. A note payable is similar to an accounts payable, but again, it's typically for a larger amount. It has a longer payback period, so we're not going to pay it back in 30 days, but maybe we're going to pay it off over 6 months or a year or 5 years or something, and usually it has interest. So if you've ever heard of someone call it like a car note, then that's a note payable to a bank. An accrued liability, we'll talk about these a little bit more in Chapter 3, but accrued liability is something that we owe haven't paid it yet, but we know that we owe it. We haven't recorded it yet. So like, I know I'm going to have to pay my rent next month, so I can go ahead. I have that accrued liability. Or I know my taxes are due, so I've got to record. I know I have that debt even though I haven't previously recorded it. I know my employees are coming to work, so I'm going to have to pay them even though I haven't recorded that yet. Unearned revenue is an interesting one. So I want you to star, highlight, underline unearned revenue in your notes. First of all, you'll notice it doesn't end in the word payable. It's one of the few liability accounts that does not end in the word payable. Unearned revenue is when a customer pays us for something in advance. So they pay us before we've done the work or provided the service. Now remember, we talked about we record revenue when we earn it, when we do the work. So unearned revenue is when we get paid for something that we have not earned yet. So if I take a customer's money, but I haven't provided the service or provided the good yet, I now have a debt to them. I took their money, but I owe them something. Since I owe them, I have a debt to them. And so that debt is called unearned revenue. You'll also sometimes hear it called deferred revenue. Once I do the work, then I get to call it revenue. And so we'll learn in chapter 3 how we're going to go back and transfer that out of the liability into the revenue account because I've finally done the work. So our equity accounts, we've talked about common stock. Remember, that is shares of ownership. We've talked about dividends. That's how we distribute equity to our owners, how we share the wealth with our owners, so to speak. Then we have revenues accounts. Now, we may have service revenue as a revenue account that we've used before. When we get to chapter 5 and we start selling goods, we'll call it sales revenue. Let's say that we have an empty office that we're renting out just kind of on the side. We may call that rent revenue. So we may have a couple of different revenue accounts. And then expense accounts. Remember, expenses are the cost of selling goods or services. Almost all of our expense accounts end in the word expense. So if we have to pay rent, we have rent expense, we have salary expense, we have utilities expense. We'll eventually have insurance expense or supplies expense, lots of these different expense accounts. Now, I do want to make a comment about when we're doing these journal entries and we're talking about the account names, you want to be very specific in your account name. So you don't want to just say rent, because we don't know then if that's rent expense, if that's rent revenue, if that's maybe prepaid rent, because those are 3 different accounts that have the word rent in them. So you want to be very specific about what the account name is.